PNC companies are PNC companies, and that's what they focus on. Yeah, they might offer life insurance, but it's not going to be the same kind of life insurance or perform the same in life insurance as it would if you work directly with a life insurance company. So if you're going to buy life insurance from a life insurance company, not a property and casualty.
You have to have an age that you run math backwards off of. That's the 121 for companies in the United States. If you're in Canada, I believe that's still 90 or 100. It's not 121. Canada is the only other country that offers whole life policies like this, which is pretty fascinating, of the United States. So you work backwards from 121. So what Brock's saying is that the math occurs this way. There's three characters at a high level. Premiums we pay, cash value it creates today, and the death benefit it creates tomorrow. And what occurs there, if we want to think about it, if you've ever played tag, and I'm taking this straight from my buddy Richard Canfield, the cash value created today from the premium you paid is chasing or playing tag with the death benefit. So when Nelson said peanuts in, peanuts out, he also said don't be afraid to capitalize. What he was saying is our capital, our dollars have.
Welcome to the Cashflow Legendz podcast with your hosts Nate, Brandon, and Brock. Remember, our insights are not direct financial advice, so consult with your financial team before making any decisions based on the topics discussed in this show.
Welcome back to Cashflow Legendz. Nate and Brock and I are real excited to be here to zoom out today and talk about the product that we believe in, tied to becoming your own banker and the infinite banking concept, which is whole life insurance. And we're going to really break it down from we're going to try to make it simplistic. That's the goal today, because we forget sometimes, Nate and Brock, that we do this every day and this is what we live for, and we talk about this and this is what we understand and we try to be experts in it. But the reality is that there are a lot of people that come to listening about this concept or this behavior and they go, I thought whole life was this, or this, or I was told that whole life was this, or this. So before we get started, guys, how are you? What's going on in your life? What are you most excited about? We don't have to stay here long, but just tell me, a win or something that the Lord gets glory for over the past week or two.
Great question.
That I did not give them heads up for.
Life is good. Business is good. Last week, Nate and I got to hang out together at a conference, which was awesome. I got a call that I might have a surprise golf trip coming up too. So
nice.
Fingers crossed I get that one in the books.
Okay.
We'll see.
Okay. Can you tell us where that golf trip is? Or is it
Pebble Beach?
Whoa.
Very nice.
Nice. Hey, Nate, when we grow up, I want to be like Brock.
Yeah. I think I'll find out next week, I think.
Okay. Cool. Nate, what about you?
Yeah, just a lot of fun, unique opportunities that I've been able to connect with a few individuals in the last month, specifically in the last week, and just pour into them. And one of them happened to be my son, who called me yesterday, who was going through some stuff, and I just got to come alongside him as not only a father but a brother in Christ, and encourage him in some things.
Very cool. One of the things that I would say that I got to experience over the past week is, and this will tie into today, is I was in Cincinnati, Ohio, downtown, and I got to meet a lot of people, probably 35 or 40, that are investing in their own learning and education and mindset. And this particular event was called the Nelson Nash Institute Coaching Academy. So for anybody that hears us talk about whole life today and becoming your own banker, it's going to tie into Nelson Nash as far as the Becoming Your Own Banker book that he wrote in 2000. But the coolest thing about it that I thought was two things. Where the event was hosted, the entire block and the hotels were owned by the insurance company that was hosting the event. And one of the coolest views that I've seen of a downtown area was at the top of the patio area of one of the hotels, the hotel I was staying in, and many of us were, of the entire downtown. And the funny thing is, and for those of you who don't know how insurance companies work, you're going to be like, what are you talking about? There's a very well-known insurance company the largest building downtown across the street that I could see. But I was talking to, I guess you call him probably the VP of this company, and they own that building. It does not have their name on it. It's another insurance company, but they own it. And there's a difference between the two companies. And we'll talk about that later. So it was a great reminder that we are either growing and learning or we are going backwards. You cannot remain stagnant. That's impossible because the world is passing us by in our thinking and our understanding. So it reminded me of Nelson Nash. One of his favorite words that he uses, one of my favorite words, is he was always encouraging you and I to ruminate on what was really going on. And ruminate, just think about how we think. All right. Yeah, I saw your face. I was like, oh, all right. So today, guys, there's always so much to be thankful for. We get to hit record and talk about something that we would talk about without recording, without sharing it out there in the open, market. But today we're going to go at a high level. What is whole life insurance, specifically dividend-paying whole life insurance? Where does it come from? Why do we believe in it so much? What are some differences out there in the market of things we hear about compared to whole life and why they're not the same? And just kind of zoom out and say, hey, if I was starting from the very beginning, what are things that we wish we would have understood, or I wish I would have understood when I began this journey of the power of dividend-paying whole life insurance and what really occurs with it. So, Brock, at a high level, zoom us out. Where does whole life insurance come from? What kind of companies carry it? Why are those things important to know first?
Great questions. So to start, we want to make sure that we're working with mutual insurance companies. These are guys like Penn Mutual, Mass Mutual, Lafayette Life, Guardian, others that I'm going blank on right now.
Yep.
We want to work with mutual insurance companies because they are the ones who pay dividends. Stock insurance companies do not. So then you look at whole life insurance in general. So if we broke it down, whole life insurance is permanent coverage for your entire life as long as you die before age 121. Okay.
Yep.
So then you have a death benefit that is contractually level and can grow over time. We have a premium that is contractually level that you can structure to reduce over time using dividends. Okay. This is a asset on your balance sheet because it has an equity portion called cash value, likely to grow at, say, 4%, tax-free over your lifetime, and a guaranteed death benefit like we already talked about. So that is like the makeup, 30,000-foot view of whole life insurance.
All right. So, Nate, I'm going to pass to you, and I'm going to break down each of your comments and thoughts to try to even zoom out more on each topic. So, stock and mutual. Brock said dividend. Break that down to where a kindergartner could understand it. What does that really mean? And why is that important for us?
So in a stock insurance company, whoever is the owner of the stock is the one that gets to participate in the dividend. But that doesn't necessarily mean that the stockholder is a customer of the company. They can just be a stockholder in general, because people buy stock in companies all the time that they don't have any connection to as far as from a consumer perspective. And that's the freedom that we have to purchase stock, is we don't have to necessarily use a product that's created by that company, whatever. So stock means that there's policy, or there's stockholders that get to share in the dividends that are distributed out. So,
and let me stop there.
Profitability.
There you go. Thank you.
Of the company. So when a company produces a profit, they allocate a certain percentage of that profit, and they share it back to the shareholders.
Okay. So Brock. Oh, go ahead, Nate. Sorry.
No. Well, that's stock.
Yep, that's stock. So on the mutual side of that, the only difference at a high level, Brock, is that we are coming into the stockholder position and benefiting from the profitability of these mutual companies. So a common conversation that I have, and I'm sure we all have, that for anyone that's just getting introduced to this concept of infinite banking, becoming your own banker, and the product of whole life, is Well, I can just go down to my local insurance guy at the local insurance office and do the same thing. And it's not the case typically. Why is that not the case, Brock? Because they're thinking about their PNC insurance company typically. Why is that not the case?
Because PNC companies are PNC companies, and that's what they focus on. Yeah, they might offer life insurance, but it's not going to be the same kind of life insurance or perform the same in life insurance as it would if you work directly with a life insurance company. So if you're going to buy life insurance from a life insurance company, not a property and casualty company.
Yeah, and this is
Well, and just for simplicity, property casualty for the layperson is just a home and auto insurance agent, essentially.
Thank you, Nate. Yep. Thank you. Y'all got to coach me up too, because I get so used to using these terms in our world, I forget that it's not layman terms. All right, so we talked about the difference between stock and mutual, and Nelson made it clear doing business with a mutual company that's been around for 100 plus years, that's been profitable, meaning they've shared dividends with us as owners and stockholders, is the main thing. So Brock named some companies, and there's several others out there. One of the coolest things that I've learned over the last several years is that these mutual companies didn't just luckily become profitable. They didn't just go, oh, we figured it out and we just hit the lottery and we know how to have more money than any other place that you can keep money. So let's go historically a little bit to what is the truest intention of insurance and the product of whole life and how that ties into a mutual company at a high level. Like really what's going on there.
Great question. So with whole life insurance, it's guaranteed to be there when you die. So what the insurance company is doing is they are intentionally overcharging you on your premium to set money aside to guarantee the fact that you're going to have a death benefit there one day when you die. Okay. Now, while they're doing that, you also get access to that overcharging price that they have. But as of today, whole life insurance is really the last product that's guaranteed to be there for you when you die, no matter what age you're at. If you're 14 days old today or 90 years old today, like it's going to be there regardless. Like you are going to die and it's going to pay out. So what you want to think about there is with mutual insurance companies, they are investing in a way that is conservative but powerful enough to say we're going to be here when you need us the most. So with stock insurance companies, remember their owners are the shareholders. Number one rule of owning a business, increase shareholder value. Like that is rule number one. You learn that in business school. With mutual insurance companies, they're private companies and they're owned by the policyholders. So where one business is making decisions based on returns to their shareholders, the mutual insurance companies are making better decisions around the guarantees of the fact that they will be there when you need them in a conservative, safe way.
That's good. All right, Nate, you and I come from the background of understanding whole life was not necessarily a good thing for many, many years until we read Becoming Your Own Banker. What was if you could go back to the first time right before you read Becoming Your Own Banker and take yourself back there, what do you think you would say at a high level it was your most misunderstood thing about the product of whole life and mutual companies before you understood Becoming Your Own Banker and reading it and living it and teaching it? You remember one thing that you were just like, I was wrong on that?
Yeah. No, very, very clearly, I remember one thing that I was dead wrong on.
Okay.
I assumed, and maybe some other people assume this as well, that the premium that you paid was the death benefit that was added to the policy. Like my premium was so here was my misunderstanding right out of the gate. A $10,000 premium, I assumed only got me $10,000 worth of insurance.
I got you.
That was a strong misunderstanding that I had right out of the gate. So my first aha moment was, wait a minute, there's actually multiples of death benefit on this whole, like I knew what term insurance was. I knew that little bitty death benefit, large death benefit. I mean, little bitty premium, large death benefit. I knew what that was. I had it. I didn't have any understanding of whole life insurance whatsoever. So I just assumed that the money that I was putting into it was basically just going to build the death benefit.
All right. So you said something there, Nate, about whole life and term. And Brock, you said something earlier about policy owners versus shareholders. Connect those two dots a little bit on, is everybody benefiting from the profitability of a mutual company as a policy owner?
No,
Ooh.
they are not. So the only way that you would profit from the insurance company profiting is if you own a dividend-paying whole life insurance policy. If you own term insurance, index universal life, variable universal life, you're not receiving dividends from the insurance company, right? You're just getting the privilege of having a product with them. If you own a variable or index universal life, some people might say, oh, well, you are profiting. Well, not really. You're just getting help. If it's an index universal life policy, you're just getting help from how the insurance company invests their money in the market. If it's variable, you're just getting stuff from the market.
Yep. So
Can
those,
I go back
go ahead, Nate.
real quick
Yeah.
on something
Yeah.
I just said earlier? I want to give a little bit of context. The reason why I thought that for so long about whole life insurance is because I listened to Dave Ramsey talk about how you never get your cash value. Your cash value is lost or whatever. And since I never really leaned into learning what that meant, I just assumed that there was no value to me that was created through the money that I was putting into it.
Yeah. One line that Nelson says, and I think in Becoming Your Own Banker, and I'm paraphrasing here, that reminds me of this conversation so far, is that they misnamed the product of whole life insurance. It really should have been named a cash flow system that also has a death benefit. And that's hard to understand. A banking tool with a death benefit. So I was reminded of this, Brock. You said something earlier. You said age 121. Let's touch on that for a second. And I want everybody listening to go here. I want to really at a high level go, this is what's happening in a whole life policy. There's the play, the characteristics and what you're doing. Mm-hmm. You have to have an age that you run math backwards off of. Mm-hmm. That's the 121 for companies in the United States. If you're in Canada, I believe that's still 90 or 100. It's not 121. Canada is the only other country that offers whole life policies like this, which is pretty fascinating, other than the United States. So you work backwards from 121. So what Brock's saying is that the math occurs this way. There's three characters at a high level. Premiums we pay, the cash value it creates today, and the death benefit it creates tomorrow. Okay? And what occurs there, if we want to think about if you've ever played tag, and I'm taking this straight from my buddy Richard Canfield, the cash value created today from the premium you paid is chasing or playing tag with the death benefit. Simple as that. So when Nelson said peanuts in, peanuts out, he also said don't be afraid to capitalize. What he was saying is our capital, our dollars have to go somewhere. And we choose where it goes. So if I know that these things happen guaranteed inside a product, every time I pay a premium, the death benefit goes up and it allows the cash value to chase it. And it's going to tag it eventually. It's all directly related to my behavior as a policy owner. There's nowhere else that we can control guarantees like that, first and foremost, like Brock and Nate have said so far so well about where our dollars go first. Now, are there details and semantics and splitting hairs on how you do this or how you do that? Yes, but that's not the purpose of this. The purpose of this is to understand that when you pay premium to a dividend-paying whole life policy, you and I are owners in the profitability and the growth of that company, and you and I get first right privilege to use the cash value we created by the premium we paid. We also have a guaranteed death benefit that will pass to our beneficiaries, not if we graduate, but when we graduate or leave this earth, as Nelson said. Those things are guaranteed. What all happens outside of that's a whole nother conversation for another podcast. And that's a key piece, isn't it, Brock? Very important. We're just talking about the product of whole life. What is at a high level? What is the purpose of insurance at a mutual company, specifically whole life? Like, what's really happening at a large scale? Either one of you take it.
I would say that number one, the premiums are higher because they're overcharging you to guarantee the fact that you'll have they can set the money aside so they can pay the death benefit out. But that also is allowing them to have capital on the side to invest in other aspects within their business to grow their business, right? Because they are in business, they want to grow their business, and they have premiums coming in, so they get to do something with it. And we as whole life owners benefit from their investing skills, which just so happen to be, the best in the world.
Yeah, let's talk about why they're the best in the world. Go ahead, Nate.
Well, I was just going to say, as a mutual company, we're kind of coming together as a community to, pull our resources together where there's mutual benefits that get distributed back out.
That's good.
And I'm trying to remember what I was going to say earlier. When it comes to like whole life insurance versus term insurance, when people think in those aspects, the one thing that I will say to someone who's even considering whole life insurance is you better make sure that you're thinking about this for a lifetime and not just in 5 or 10 year blocks. There's a reason why Nelson's number one principle is you got to be willing to think long term. Whole life insurance creates value day one. But the longer that you own that policy, the more value is realized.
And Brock, does that value with our ability, combined with our ability to think long range, like Nelson was a forester and thought about 30, 40, 50 year chunks of time, does that speed up the benefit of our whole life insurance policies that we own if we're willing to think long range and fund them with premiums? Does it benefit us dramatically more and more each year?
Absolutely.
Is that magic?
No, it is not magic. It is actuarial science. It is actually the absolute opposite of magic.
One of the things that I ask often is, because of my misunderstanding, because I believe someone else's truths instead of researching it myself, was how do they come up with these numbers? Like, well, if you're a numbers person, how do they come up with them? They're not guessing.
It's the law.
Well, they guessed on the first one. They guessed on the first one.
Yeah. That's true. That's a good point.
And if anybody was wondering, like, when was the first one? Like, let's just take Penn Mutual, for example. Their first one was in 1847. So, long time ago.
And we get asked a lot of times, why do you work with the companies you work with? We keep it simple. Mutual company, 100+ year consecutively track record of being profitable, and they offer the product of dividend-paying whole life insurance that we can be an owner in. It's really that simple. And Nelson said this becomes ridiculously simple once we know what the problem is and we'll know what the solution is. And so this is how I had this conversation today with somebody this morning. They said, can you work with my financial advisor to help him understand this? I said, not if he doesn't want to.
Yeah.
But if he does want to, absolutely, we're going to make each other better.
Yeah.
For you. And so one of the things, and I'm reminded of what Ryan Griggs said, Nate, at the last think tank we were at. Ryan Griggs is pretty brash. And I would say that too, Ryan, visiting with him. And I love that about him. He's like,
he'll admit it.
Yeah. I go around teaching people that want to learn the truths of a product that has been so misunderstood over the last 45 years. That's what I can't wait to do. Like, I do that just because I love it. And so when you do a little bit of studying on whole life, Nate or Brock, whoever wants to take it, was the product of whole life insurance used often by many people, let's say the majority in America, up until around 1980.
Absolutely.
Why?
Well, because number one, the stock market wasn't as heavy as it once was or is now. And we had these things called defined benefit plans. Like if you go back to World War II, I think there's a stat out there that 50% of Americans had their money but in general in their house, annuities, and whole life insurance. 1980 came along and a big shift happened from going from defined benefit plans to defined contribution plans. And what is a defined contribution plan? It is the 401k. So what happened was it took the risk and the pressure off of the corporations and then moved it to the consumers and workers, the employees.
What's interesting about that is you went from a time where people were having to do some legwork on their end to invest in the stock market, right? There were some things that had to take place. There were some decisions that had to be made, all this stuff to be able to participate in the stock market, to where now it's on autopilot, where you have to check a box to say, I don't want to participate every time you work for a new company. And so putting Americans' paychecks on autopilot, I mean, that's a natural occurrence of what's going to take place. There's more money that's being diverted and poured into those places. And the mainstream narrative is that's where everybody needs to be. Your 401k is going to save you and, all that stuff. And you got to have one. And if you don't have one, you're a crazy person, all those things.
Well, and I also want to encourage everybody listening to explore the idea of, if you believe your retirement plan is going to do what you think it's going to, can you explain why with certainty or how with certainty? If you can't, that's a really, really good place to start. And I'm talking to myself. When I began to read and understand Becoming Your Own Banker, and I read it for the first time, and I began to understand the process of money flow goes on forever, I had to teach a retirement system. And what they market it as is somewhat of a pension plan. What they didn't tell me is that no matter how hard I work, they could keep changing the rules, which they did a couple of times, and they could keep changing what percentage I had access to when I eventually did retire. Now, I'm using air quotes for retire because I don't think it's a word that we really understand, but it's a word that I used to believe was important. I don't anymore. I believe purpose and intention and all of those things and how we live our life are much more important than just retiring. All right, because what are we retiring from? And so when we began to study this, what I began to realize, and what we began to realize, Nate and I, is that what we thought to be true just wasn't. Simple as that. And I don't know about you guys, but I like to be right.
No way.
Yes.
I do too.
Yes.
I like to be right. On Twitter one time. The reason why I share my opinions is because I'm not afraid of being right.
Yeah. So the first reality is do we think we know everything about everything? Or is it a half truth, a misguided truth, a misunderstanding? And the beauty of this whole process of what we're teaching and why we believe that, let me put it this way. Had a guy who knew Nelson for over 30 years at the Nelson Nash Academy that I was visiting with. And he's reread Becoming Your Own Banker like over 500 times. The reason he said he's reread it is because it is a workbook for a 10-hour course. Nelson used to travel around and teach you the power of dividend-paying whole life insurance over 10 hours in 2 days. He created the book in 2000 kind of as a way to document it and be reminded of the things that he talked about, because he went from being the crazy man to people going, oh, this might make sense. Okay, because he did that for a long time. But what Tim Urich said, this guy that's known Nelson forever and spent a lot of time with Nelson, is he said, This is ridiculously simple. It does not need to be sensationalized. It does not need to be hyperbolic. It is just the reality that you can do this mindset anywhere through any product. It doesn't have to be through dividend-paying whole life insurance. It just may not give you the benefits that dividend-paying whole life insurance gives you. Not may, it won't, from our knowledge and experience so far. And we are open. How cool would it be if somebody said, I challenge you, Nate and Brock and Brandon, respectfully, and I want to come on your show and I want to prove to you why you're wrong. Let's go.
I don't do those anymore.
Oh, well, if we knew who it is, and
I would just put it out there to anybody. Show me an asset that you have the ability to leverage and control the environment with certainty and with certainty, efficiency, all those things. Like there's not another asset on the planet that we can leverage our capital with and also simultaneously control the environment.
Yeah, at a high level. Go ahead,
and that right there is why I just don't. I used to try and argue that all the time, but like once you ask the questions of like, have you actually studied it? Like, can you show me your math? Most people just can't back it up. So,
well, now I think that goes back to
if I need to, we'll do it. But
I want to retract that statement for anybody listening. We're not looking to argue with anybody. But if you want to learn what we see from our experiences, and we can tell you how it can make what you're already doing better, in our opinion, then absolutely. I think that's a better way to say it. But you're exactly right. Arguing with somebody to prove who's right, both people are going to be wrong. What's that saying? If you argue with an idiot, there's two.
Yeah.
Something like that. So what we're really getting at is that the product of whole life is very misunderstood often. And if you're willing to rethink your thinking and lean into where you see half-truths that you believed and get clarity on why it was a half-truth or a misguided truth or wrong altogether, then you're going to get a lot of clarity on what you do and why. And it's going to have nothing to do with what we think. We'll just ask you the questions. And that's what I think Nelson did a really good job of in Becoming Your Own Banker. Of like, he wrote the book, Becoming Your Own Banker. He says this over and over again for the average Joe. This is not something to sell insurance by. It's not a sales tool. And I shared this morning. One of our favorite success stories, many of them, and Nate and I's world and who we work with a lot, is the couple or the newly married couple or the couple that's trying to make it that has so much headwind debt, bad debt, credit card debt, that they don't know how they're going to survive. They can't breathe. And they start applying Nelson's principles through the product of dividend-paying whole life insurance with long-range thinking and not being afraid to capitalize. And they look up in a year or two and they can't believe the new life they've created because of their choices and actions. Not because of anything that we said you should do as a recommendation, but because they begin to understand it and live it. And that's a really cool part about this is, like you said, Brock, I'm glad you called me out on that. We don't want to argue with anybody. If we got to argue with somebody, we're wasting our time and yours. A discussion? Absolutely. That is a whole nother ballgame. So any parting thoughts from either one of you guys on the simplicity of whole life, mutual companies? Is there something that y'all want to be sure we touched on that we didn't? Or are you guys good?
I'm going to say, no, I don't think so. And then I'm going to share a comment.
Okay.
We talk about the fact that, no, I don't think so, but I still have comments. So,
okay. I like it.
Everybody does it. It's like, no, I don't have comments. And then they're going to give you their comments. It's simple if you take the time in the mindset of, and I talk with financial advisors about this a lot. Don't approach this as this doesn't work and here's why. Approach it as this may work. I just don't know if it's going to work for me. And find out why. Because that way you actually have an open mind of saying, oh, wait a second, I can actually learn things that I didn't know and then make an actual education or educated decision around, do I implement this or do I not implement this?
That's good. Nate, any parting thoughts?
I would just say, people are often surprised what they can accomplish. I think another misconception is this is kind of out of my league right now. This may be something, maybe once I have more money one day, this might be something I can apply, but it's kind of out of my league right now. Well, without someone's perspective kind of looking at your situation, you may not realize what you're truly capable of unless you reach out and have a conversation with somebody who's done this.
That's a
And
good point.
so wherever you feel like, hey, I may not be able to do this right now because I don't have XYZ, there's probably people who have started with less than what you have.
So good. So good. And that's a reminder of, we're going to always send you to educating yourself and leaning into rethinking your thinking. And that's how we really decide if we're a good fit for you and you're a good fit for us, is are you willing to do some legwork and grow and learn? Because we don't want to ever tell anybody what to do. We want to know why they want to do it so they can win at the life that they want to win. All right. So we appreciate your time. We appreciate your willingness to share 30-something minutes with us. We do not take that lightly. We're so grateful for anybody that shares or subscribes or makes comments. We have to pinch ourselves sometimes that we just get to do this and people actually listen. I mean that genuinely. Like, I'm like, when people tell me they listen to our podcast, I'm like, Lord, keep my pridefulness out of the way. This has nothing to do with me. It has everything to do with you. This is just a platform you've given us. So let's be good stewards of it. So appreciate everybody. We'll catch you on the next one.